Today's market offers investors plenty of choice. There are thousands of mutual funds to pick from and any number of highly touted stocks to invest in. Finding an investment isn't difficult, but making the right choice is complicated. It's complicated by the number of options available and the never-ending noise of the market and the financial media. At Morningstar, we try to simplify the process by providing investors with a consistent framework to use when evaluating investments. This framework is rooted in Morningstar's investment philosophy. In this special video report, we'll share that philosophy, which we think is the best way to accumulate wealth over time. In the next few minutes, you'll learn about the rigorous criteria Morningstar requires before recommending a stock or fund for investors, and see how our proprietary analyst ratings and research can help you quickly find the best of the best.
Morningstar's approach to investment really focuses on the long term. So when our analysts are looking at whether it's stocks or mutual funds, we're trying to take a long-term view. So we're forecasting cash flows over the long term. We're looking at whether a fund manager can outperform over the long term, over a market cycle. Also, it's very tough to predict what the market is going to do or what a security is going to do over the short term. So we feel like that's a loser's game. We know from our research that one of the biggest factors driving investment returns is cost. If you're trading frequently, if you're investing for the short term, those costs go up. Unfortunately, investors are wired to think too short term, in our opinion. So, people see trends when they're really not trends there. We know from our research that costs are one of the key drivers of investment success. And so if you take a long-term view, cut down your trading costs, only trade when you truly have information and not trading based on noise, you're going to have better investment results.
But maintaining a long-term perspective requires patience.
Because of our fundamental long-term approach, we're sometimes going to be out of step with whatever's popular at a given moment. So we may be pounding the table on a stock that's way down because we think it's a good value. We may be pounding the table on a certain manager even though their style is out of favor. That fundamental long-term approach is often going to point us to opportunities that are just out of step with the current environment.
While both analyst-driven and fundamentals-based, our stock and fund recommendations are arrived at differently. In both cases, however, our opinion of whether a stock or fund is a buy is encapsulated in our ratings. The Morningstar rating for stocks compares a stock's current price with what Morningstar's analysts think the shares are worth. If a company's stock is trading above what analysts think the shares are worth, the stock receives a 1 or 2-star rating. That means the stock is overvalued. If a company's stock is trading below what analysts think the shares are worth, it receives a 4 or 5-star rating. In this case, the stock is undervalued. And if the shares are trading right around where analysts think they should, the stock receives a 3-star rating, which means the shares are fairly valued. From a price perspective, a 5-star stock is a better investment opportunity than a 1-star stock. How do Morningstar analysts determine what a particular stock is worth?
To figure out what a company is worth, an equity analyst has to figure out what the company can generate in the future in terms of profitability and cash flows. That means that they have to investigate the company's products and services and think about what those products and services can command in the market well into the future, 5, 10, 15, 20 years. They populate a discounted cash flow model with their forecast for profitability and cash flows. Then they discount those cash flows back to today using a rate of return that reflects the risks and uncertainties of the security, and that helps them determine what the intrinsic value is or fair value estimate of that company today.
Once analysts arrive at their fair value estimates, they apply what's called an uncertainty adjustment.
In some cases, say in the consumer sector or regulated utilities, the revenues that a company can generate are not very subject to cyclicality. The companies have high margins, they don't have a lot of debt, so the range of potential fair value estimates is actually quite narrow. In other cases, a company might be hit with a high number of uncertain assumptions that are required to make the fair value estimate: commodity prices, operating margins, production levels, and then if they have on top of that financial leverage, the range of possible fair value estimates can be so big that the analysts have a very high uncertainty rating on the company.
As a result, it's more difficult for a stock to earn a 5-star rating if our analysts are less confident in their fair value estimates. At any given point in time, many stocks will have 4- and 5-star ratings. How can investors choose the most promising undervalued stocks of the group? We think the key is focusing on economic moats. By focusing on moats instead of price alone, investors can truly take a long-term view of the world and more effectively shut out the noise of the market.
An economic moat is a sustainable competitive advantage that allows a company to generate economic profits for 10 or 20 years or more into the future. Really, it's something that's structural to the business that allows the company to fend off competitors and protect its profits for the benefit of shareholders for many years to come.
Morningstar has identified 5 sources of moat. Switching costs are those obstacles that keep customers from changing from one product to another. The network effect occurs when the value of a good or service increases for both new and existing users as more people use that good or service. Intangible assets are things such as patents, government licenses, and brand identity that keep competitors at bay. A company with a cost advantage can produce goods or services at a lower cost, allowing them to undercut their competitors or achieve higher profitability. Efficient scale benefits companies operating in a market that only supports one or a few competitors, limiting rivalry.
A good example of a company with a wide economic moat is Johnson & Johnson, and it has a few sources of economic moat. One is the intangible asset of patent protection on its drugs. It also has some switching cost advantage in its devices because once doctors learn how to use a particular device, they're unlikely to switch to a competing product.
All else being equal, a 5-star wide moat company is usually a more attractive long-term investment than a 5-star no-moat company. In 2011, Morningstar introduced the Morningstar Analyst Rating for funds, also known as the Analyst Rating. Funds that earn the highest analyst ratings are called medalist funds. These are Morningstar's picks.
The fund analyst rating is really about competitive advantages. What makes a fund better than the rest? Is that a sustainable advantage? Is that really going to drive performance? We look at all those things. What are the competitive advantages, disadvantages, what are more neutral, and we come up with an overall rating. There's no real formula to it. It's really assessing all of these pieces, all the key fundamentals, and we put all those together in our long-term risk-adjusted assessment we call a Morningstar Analyst Rating.
When we think about a fund and its prospects over the long haul, we think about it through the lens of our 5 pillars, our 5 Ps. These are process, people, performance, price, and parent. And these are really the fundamental factors that we believe drive the success of funds over the long term.
For each pillar, Morningstar analysts assign a positive, negative, or neutral score. The first pillar is process.
Process pillar gets to the question of whether a manager has a competitive edge that's sustainable over the long term. Is the process repeatable? So for example, you occasionally see a bond fund where they've made 1 or 2 macro calls well, but really haven't invested in the resources to do that well over the long term, and you're not seeing them add value in other ways that we view to be more repeatable. Where you see those investments and they can prove that they are adding value through a variety of different metrics or really doing a good job picking bonds, that's a situation where we're going to look favorably upon a fund's process.
The second pillar is performance. When evaluating performance, we don't hinge on the recent past.
Performance is a little more subtle than you'd think because you might think, well, it's just how well did the fund do the last 3 years? But really, there's more to it than that. We look at multiple time periods. We want to know how did the fund do in a bear market and a rally. We want to know how did the fund do over the entire manager's tenure. And we also look at it on a risk-adjusted basis. So all those things go into our performance score, and then we assign a negative, neutral, or positive rating.
The people pillar assesses the fund manager's talent, tenure, and resources.
With the people pillar, as its name suggests, we're looking at the people behind the fund. So we start with the named portfolio managers. We want to understand their tenure, want to understand their investment alongside investors in a fund. That's a very important element. But we're also looking at the other people involved in a process. So that's the analysts on the fund, the traders on the fund, any other resources that are available to the manager in making his or her decisions.
The fourth pillar is parent.
At first glance, parent wouldn't seem to be that important to a fund company. After all, you already know the manager and the strategy and performance and fees. But really, over the long haul, parent can become very important. The parent is responsible for bringing in new analysts, choosing a new manager, hiring and firing managers, setting fees. So really, we see that the firms with really good parents tend to have much better fund performance and those with weaker parents have worse. So you might find a really good fund from a weaker parent, but over time that weaker parent might hurt it, and vice versa. So parent is really an important measure for the long haul.
The final pillar is price.
Price is a really crucial part of our process in evaluating a fund, because we know that price is the best predictor of future performance. We want to dig into the fee. We want to understand, are there break points or other things that might move the fee up or down? But it's really an important part of the overall fund's evaluation and therefore the analyst rating.
The 5 pillars aren't rolled up to calculate the fund analyst rating. That's because for some types of funds, 1 or 2 pillars may be more or less important than the other pillars.
Not all pillars are created equal. Really, we look at all of them, but in some cases, for instance, let's say a focused equity fund, the people in process might be more important. For an index fund, price is going to be important. But also, they're pillars, not silos. So there's a relationship. They're all working together. They're all relevant. So you want to understand when you evaluate a fund, how are they all coming together? It's less important to get everything in the right pillar as it is to understand how it all works together for that overall rating.
The analyst rating is based on the analyst's conviction in the fund's ability to outperform its peer group and benchmark on a risk-adjusted basis over the long term. If a fund receives a gold, silver, or bronze rating, it means that Morningstar analysts expect it to outperform over a full market cycle of at least 5 years.
We have 3 levels of recommended fund ratings, bronze, silver, and gold. Those are differentiated really on the probability the fund will outperform, really on how many of the strong fundamentals a fund has. If it has a lot of strong fundamentals, if we really think there's a very strong case for it outperforming over the long haul, that's going to be a gold fund. Not a lot of funds get a gold rating. If we think it's somewhere in between, we may give it a silver rating. If we think it's got some good fundamentals, but maybe also some flaws, it's going to have a bronze rating.
Analysts don't assign ratings in a vacuum.
The ratings process doesn't end with the analyst completing their research. They then bring the rating recommendation to the ratings committees, which vet the ratings for consistency, completeness, and a sound logic going throughout the rating.
Despite being forward-looking, Morningstar's analyst ratings are not short-term market recommendations, nor are they market calls on fund categories or asset classes that Morningstar thinks might do well short-term.
At Morningstar, we believe that investors should take a long-term approach to investing, and that's how we approach our Morningstar analyst ratings. There's a couple reasons for that long-term approach and why it's so important. First of all, the goals that investors are saving for are often long-term goals, be it saving for retirement or saving for college. We also know that good strategies and good processes are designed to shine over the long haul and do shine over the long haul. So we want to be thinking about that when we're thinking about our Morningstar analyst ratings. Finally, research has shown that when investors make short-term decisions or decisions made based on short-term performance, they don't make the best choices. So we're always stressing that long-term approach really to help people make the best use of the funds and the investments that they have.
By focusing on more fundamental elements like risk, long-term performance, and costs, we help fund investors make sound, long-term investment decisions that aren't skewed by what's currently happening in the market.
Ivy High Income is a good example of where our Morningstar analyst ratings serve people well. It's a fund with a great performance record that had been attracting assets at a rapid clip. But when we initiated coverage of the fund, we put a neutral on it. We were concerned about some of the risks that the fund was taking. It's a high yield fund, but was aggressive even by the standards of that category, and also had some concerns about the parent. Then the fund lost 2 managers in rapid succession, and we downgraded its Morningstar analyst rating to negative. The fund has since underperformed pretty dramatically in a rough period for credit, and investors who have stayed away have benefited from that decision.
The path to becoming a stock or fund pick is a long one, rooted in rigorous, ongoing research conducted by dozens of analysts. And while no one knows for sure what is going to happen in the market, we firmly believe that buying and holding fundamentally sound investments over the long term is a surefire way to accumulate wealth and meet your investment goals.